Hi, friends. There has been a lot of talk lately about inflation. Inflation is very high right now, and a lot of folks are asking themselves, what do I do about it, right? The purchasing power of my money is less, it is harder to live. How do I arrange my finances in a way where I can protect myself against inflation? So, that is exactly what we're going to be looking at today, which is how to capitalize on the current very high inflation. So before we look at that, I really quickly want to go through sort of what is causing folks to be stressed right now when it comes to their finances more than usual. So like I said, on one side, we have high inflation. What inflation does to us is that it decreases the purchasing power of our money. I have $100 today. It is worth less than, or that what I can buy with $100 today is more than what I could buy with that same $100 tomorrow. So it's decreasing. Our purchasing power's cost is going up. Uh, One thing to know is that a small amount of inflation is widely considered a good thing, right? Just a little bit of inflation is considered healthy. It's considered normal. Currently, inflation is about 2.5 times what is considered healthy or normal. A lot of different factors are going into this. Two of the big ones, though, is that we have this increased demand post. I don't want to say post pandemic because we are still considered to be in a pandemic, but people are doing more things and there is increased demand in that side. And then also, of course, we have war in Ukraine, which is messing with a lot of our supply chains and things like that. I think we're going to see a lot more of that in the future. On the other side of things, we also have concerns of a recession. We're considered in a recession if the U.S. has two consecutive quarters of shrinking GDP. We've already had one, and there are signs that look like we could be looking at another one, in which case we will be considered to be in a recession. Partly this is due to the inflation that we talked about. Also, the Fed has hiked up interest rates to sort of try to combat inflation, which is interesting. But what this does is it makes it more difficult to borrow on things like homes, starting new businesses, all of that. So it decreases some of our growth there. So this can affect our job security, our wages, all these types of things there. So when we have times of economic uncertainty, what most people do is they start saying, oh my goodness, things are going wrong. I need to spend less. I need to save more, and I need to avoid investing. Here's the problem with that strategy. Right now, you are losing money in your savings account. Let me show you what I mean. So if you have a savings account at Bank of America, for every $10,000 that you have in there, each year you're going to get about $1. Great. If you have a high yield savings account, let's say with Ally, for every $10,000, you're getting $90. Okay, a lot better. But the problem is, and this is why you're losing money, is that in purchasing power, because of inflation, you are essentially losing $860 per year in that purchasing power. So yes, maybe I made $90, but I lost 860 in terms of what I can actually buy with that money I invested. So in order to beat inflation, the interest that you get from your investments needs to be greater than what the current inflation rate is. That's where the Series I bonds come in that can help you. So again, let's look at this. Bank of America, we got about $1, Ally $90. And with a Series I bond, for every $10,000 that you put in there, you're going to get about $962 per year. So let's just break it down for a little bit of easier math. With Bank of America, you're basically getting 0% interest, okay? Let's be real. A dollar on 10,000 is 0% interest. Ally, we're looking about 1%. At the Series I bonds, we're looking at about 10% interest. So let's break down really quickly. What is a bond? What do I need to know if I want to get a Series I bond? So first of all, a very simplified version of what a bond is basically you giving the government a loan. And just like if you take out a loan from the bank and you have to pay them interest, Same thing. You give this little loan to the government called the bond, and they are going to pay you interest. Bonds are considered the safest investment because they are backed by the US government. Now, a Series I bond is basically a bond that is created in a way that will always beat inflation. It will always beat the inflation, the current inflation rate. So think Series I for inflation. So currently, because inflation is really high, the interest return from Series I bonds is also really high, 9.62% return. So this interest accrues and compounds every 6 months, and it is also recalculated every 6 months. So let's say in the next quarter, I think the time they'll calculate it is November. Don't quote me on that. They will look at the interest rate and then, readjust this, whatever the return is. Right now, it's 9.62. What's important to know here is that you cannot lose money on Series I bonds, even in times of deflation. So if there is a period of deflation, which can happen, it has happened, the Series I bond interest rate is just going to go to zero, which, by the way, you're still going to be essentially making money in terms of purchasing power because there's deflation, right? So your money stays the same. So you're doing all right there. So you cannot lose money on a Series I bond. Now, in terms of the timeline, this is really important. Once you purchase a Series I bond, you can't access that money for a year. So if you do not have enough saved in your emergency, or you're thinking, oh, I need to use my emergency fund and put it in the Series I bond, no, because you cannot touch this money for 1 year. It is gone. You cannot use it. If you cash in the bonds before 5 years, you forfeit the last 3 months of interest. Okay, so let's say, I put in $1,000, I make 100, and in the last 3 months before I cashed out, of that 100, $10 came in the last 3 months. So I'm going to lose that $10, but I still get that $90 of interest that I made. So still not too bad, but something to keep in mind. And you can hold them for up to 30 years. A little more detail here on these bonds. You purchase them through the Treasury's website, that's Treasury Direct account. And you can buy up to $10,000 in digital Series I bonds. By the way, the lowest you can purchase is $25. So there's a range there. I haven't done this second bullet here, but something that I was looking at in my research is that you can purchase an additional $5,000 using your federal income tax refund in paper Series I bonds. So something to look into there if that $10,000 limit is lower than you want it to be in terms of purchasing your bonds. And the interest that comes from these bonds is exempt from state and local taxes, not federal taxes, but state and local taxes. There is a way to get it entirely tax exempt for certain higher education purchases. I didn't look too deep into that, but something to look into if that's something of interest to you. The digital bonds can be cashed out through that Treasury Direct account. It says it would be available in a few business days, the money that you would have. I wouldn't trust that too much because a lot of people are really into the Series I bonds right now. And, I would say a couple weeks if you're trying to plan ahead and trying to use this money. So to sum up, the purpose of these Series I bonds, or just bonds in general, they're a form of short-term investing that really can be a wealth lever for you if, number one, you already have a full emergency fund in a high yield savings account. You don't need the money for at least a year, and you're not in a position really to withstand more volatile investments. Sometimes a Series I bond is not a better investment than the stock market, but it really just depends on how soon you might need that money and just your risk aversion or your risk tolerance there. So if you would like me to do a video about how to really set up these Series I bonds, let me know in the comments. Any questions that you have, let me know in the comments there. And with that, I appreciate that you joined me for this video today.